You don't have to undo the whole 401k history. You just need a clear plan on how to unwind the concentration so that in the future, you aren't stuck with a big tax bill that you didn't see coming. Today's episode is for the person who did everything right with retirement savings and is now realizing they may have a tax problem. You maxed your 401k for 20 years or more. You have a big balance. You feel proud of it. And then you start to wonder, what will I owe in taxes when I retire? You finally see a tax projection for retirement, and it's a lot bigger than you expected. In this episode, I'm going to show you why a big 401k could quietly turn into a future tax trap. Walk through a real-world example, and then talk about what to do in your last working years in early retirement to regain control. This is really for high-income tech and biotech households somewhere in your mid-50s to 60s. You've been diligently maxing out those 401ks for the last 20 plus years. Most of your investable wealth is in taxable deferred accounts. Think 401ks, traditional IRAs, and you're, 5 years or so away from retirement when work's going to be optional. You're starting to ask questions like, what are my required minimum distributions going to be? Those things called RMDs. What tax bracket will that put me in? How much of a jump am I going to have from when I'm in retirement to begin to when we have to take money out? And is my 401k actually going to put me in a box when I'm in my 70s and just be kind of stuck paying more taxes? First, let's talk about why being over-concentrated in 401ks can become a problem later. Every traditional 401k dollar is future ordinary income. Think of it as though you're going to get paid, just like your corporate job, by paying, and when you get paid, you're going to pay federal taxes and state income taxes, if your state charges those, for each year that you take money out of that account. Now, you're not going to necessarily need to take those funds out until you reach a certain age. For most of you, that's going to be age 75 under the new rules. That can push you into higher tax brackets, increase how much your Social Security is taxed, and perhaps trigger higher Medicare premiums as well. The issue isn't that 401ks are bad. It's that if 70 to 80% of your wealth lives there, you're limiting your options later. You don't control when those dollars become income anymore. The IRS does. Let's look at a geeky little example to put some numbers to this, just to help you paint the picture. Imagine you started 25 years ago, making about $150,000 a year, and over that time, you got 3% raises every year. You maxed your 401k contribution to the IRS limit, including catch-ups when they're available, and you got a 3% employer match. If we assume you got an 8% rate of return, you'd have about $1.8 million in your 401k now at age 60. Now, let's say you're going to work 3 more years, keep making max contributions, get that 8% return to 3% match. When you walk away and retire, you should have about $2.3 million in your 401k. From there, you don't need to take money out of that 401k, which is maybe now an IRA. So you're just going to let it keep on growing. And it keeps growing at that 8% return until we reach that age where we have to take money out, age 75. Well, over that time, that $2.3 million, if it grows at 8%, is now worth nearly $6 million. Okay? And so the first amount that you have to take out is going to be about $220,000. Whoa. That's forced out. Then you stop contributing at 63 and just let it ride the same 8% until required minimum distribution age. Let's use 75. By 75, that $2.3 million is compounded into somewhere near $6 million in your IRA, about $5.9 million in this example. This is exactly what you were told to do. Save early, saved often, let compounding work. But now look at what happens with the required minimum distribution. At 75, the IRS says it's time to start taking your money out. The first year, RMD is your balance divided by the life expectancy factor, roughly in the mid-20s when you're in your mid-70s. So For the 5.9 million for the first year RMD, it's going to be 5.9 million divided by about 27, which is going to equal $220,000 of forced taxable income just from the required minimum distribution. Now, if we layer that in to the projected 2026 tax brackets, we don't know what tax brackets are going to be when you're 75. Married filing jointly couple with the standard deduction, that basically that 220,000 with a standard deduction of about 30,000 is going to leave you about 188,000 of income. Now, the kicker is, you're going to be pretty much in about that 22% tax bracket. But if we go ahead and add in Social Security, so if there's one person maxing out Social Security along the way, and we're going to take a spousal benefit from the other, you're going to have something like 90,000 of income in Social Security, right? So that's going to make that total income amount come up to around 260,000 in total. And that's going to put you well into the 24% tax bracket. Now, a thing for couples to beware of is that we often do planning where we go, okay, we're going to be the 22 or 24% tax bracket. No big deal. We'll be okay. Just be mindful that if one of you passes, which will eventually happen, right? That person who remains, their benefit of the RMDs are going to keep happening, and they're going to get the higher Social Security benefit. So they're quickly going to get pushed into probably the 32% tax bracket or maybe the 35% tax bracket. So what can we do if you recognize that this is your story and you're still working? What are the levers that we can pull to help make some different changes here? Well, the first lever we can pull is we can choose where we're saving. Perhaps instead of saving just to pre-tax or tax-deferred accounts like the 401k, we consider directing more money toward the Roth portion of the 401k or to a taxable brokerage account, not just pre-tax. Now, the second thing we can look to do in those last few years is if we're getting bonuses or we have extra cash flow or we have stock compensation, we can start building a bridge in a taxable brokerage account so that we're not forced to take from 401ks the moment we walk away. It also gives us more space and time to think about doing things like the third component that I would recommend, which is looking at doing what we call Roth conversions. In a Roth conversion, we're just simply saying, hey, when we retire, we're going to be in a really low tax bracket. Let's go ahead and convert some of our IRA assets in those years and lower brackets before we get jumped into a higher bracket when we're in our 70s. There's another lever that doesn't require you to save more money. It's simply to look at where you're investing your current money. It's called asset location. So, a simple rule of thumb for every 401k heavy investor is you may want to tilt to having more bonds and lower growth assets in an IRA or a 401k. So those buckets grow slower and lower the future amounts that are going to be forced to be taken out. Now, that means if we do that, we want to have an overall asset allocation that makes sense for us as a family. So we want to be tilting to more equity and higher growth assets in the Roth accounts and also in the taxable accounts. This is a move that can really help with tax advantaged situations. So you're not changing the overall risk profile of your investments. You're just changing where you're choosing to hold specific types of investments. So here's what it looks like in real life. It's very common to see couples who hold 70 to 80% of their assets, investable assets, in 401k accounts, especially in pre-tax accounts with this group who's retiring. Roths weren't all that available at the time. And then when they were, we were in higher tax brackets. So it made sense to keep deferring as we had. So you're going to have several $1 million in 401ks and traditional IRAs. And they've been maxing that for decades. And they're justifiably proud of it, as they should be. When you actually model out lifetime taxes in that situation, the results can be surprising. The combination of required minimum distributions, Social Security, and Medicare premiums can create a much bigger lifetime tax bill than people ever expected. So over a few years, the plan in that situation often looks like exactly what we talked about before, looking at your pie of how much do I have in pre-tax 401k accounts? How much do I have in Roth? How much do I have in taxable? And making the choice to start building out that pie so we have more choices and ability when we retire. We want to use low income years to do things like Roth conversions. And then we also want to adjust that the asset location so that we have the bonds really more so in IRAs when possible. Now, another thing to think about is if you're, like a little pro tip, is if you're charitably inclined and you've always been giving along the way, recognize that once you reach age 70, you can do qualified charitable distributions through your IRA or 401k, and that contribution can count toward your required minimum distribution. So let's land this with 3 simple steps you can take from here. First, estimate your investable net worth. Get the list out of your 401ks and your taxable accounts and your Roth accounts, your not your social security, your your stock compensation plan, your deferred compensation plan. Add it all up, see what you have, and put them into those 3 buckets. Deferred comp, 403bs, 401ks, IRAs, that's all pre-tax money. Roth accounts, like a Roth 401k, a Roth IRA, a Roth 403b, that's all Roth money. And then anything else is taxable money. See what your percentages are ahead of time. If your percentage for pre-tax is over 70 to 80%, it's time to get a plan in place. Rough draft your timeline of when you might stop working, when Social Security might start, and what your required minimum distributions might be. Based on the example that we gave today, you can get a sense. You just have to define your own expected return and what you think they're going to be worth when you retire. Then there's going to be a window for Roth conversions and for withdrawals. And that can be when it can be the most powerful. Like, really map that out for yourself. Look at your savings direction and your asset location, and sketch out your timeline for what it might look like for you to stop working. What year are you going to retire, and when are you going to start taking Social Security? And your spouse, when would they get it? And when would we start taking those RMDs? What age do we turn 75? What year is that? Really look at that and get a sense of the window of when those Roth conversions may be really helpful. How will that help you? Look at both your savings direction and your asset location. Are you stuffing more into pre-tax when you're already overloaded? Are your highest growth assets trapped in the wrong account? If you're thinking, okay, I get it that my 401k might be a tax problem, but I still don't know how much I actually need to retire or make work optional, well, we built something to help. We put together a free "How much do I need to retire" quiz. It walks you through some big levers we've been talking about. How much do you want to spend? What buckets are your money in? And whether you're broadly on track. You'll find the link in the show notes. Take the quiz, see where you land. And if you want help turning that into a real tax and withdrawal strategy, that's the work that my firm does every day. If the numbers in this episode sounded uncomfortably familiar, that's a sign to get curious, not to panic. You don't have to undo the whole 401k history. You just need a clear plan on how to unwind the concentration so that in the future, you aren't stuck with a big tax bill that you didn't see coming. Until next time.